Let's go across to Rupesh Sankhe of Elara Capital. He's now joining us. Rupesh, can you just talk to us? So far, power stocks have not really participated in the rally, whether you talk about Tata Power, Adani Power, Torrent Power, are you looking at utility sectors now in a bigger and a better way?
Good afternoon. We are positive on the sector from the fundamental perspective. I have been tracking this sector for 1.5 decades. And if you go back to the previous three valuation cycle from 2005 to 2010, most of these companies were generating high ROEs, and price to book value was trading around 3 times. Came into picture, and from 2009 to 2014, the ROE has come down, but still the price to book value were traded in the range of 2 to 2.0 times. Now, since FY14, when the renewable came into picture, the ROE has come down. But the current valuation at 0.6 times, 0.7 times price to book value is a significant discount to their intrinsic value. So we are very positive on the power space as a whole.
Right. When you talk about this 1.5 decade that you've been tracking this sector now, so, you can divide it into two parts, as you were saying. What really changed in that super cycle between 2003 and 2008? Of course, that was a super capex cycle that everybody was talking about. When you talk about returns, can such sort of super cycle returns come, or it will be just getting towards the normal?
Say, in 2004 and 2009, the CRC regulation was in favor of the So they used to generate close to 23% kind of core ROE. And there were very few players, and the merchant rates very high, 6-7 rupees. And the fuel cost was also very low. So these companies were generating higher ROEs. So they were getting higher price to book and a P multiple. But I think we still believe that the core earnings of the regulated players will remain in the range of 17 to 18 percentage. And with that, if you look at the price to book value, it's a significant discount. Just to give a simple calculation, if your core ROE is close to 18%, and if you assume the cost of equity around 11%, still it should trade in the range of 1.3 to 1.5 times price to book value. And now going ahead, we are seeing a lot of reforms from the government in terms of Saubhagya, Power for All, or maybe new electricity tariff, which is in the cabinet. That can be a game changer for the power sector. So in the entire value chain was the weakest link in the power sector. But now government has increased the focus to reform the distribution sector, which is going to be the game changer in the power sector. So that way, these stocks are available at attractive valuation. Even if you look at the dividend yield of the regulated players, which are at around 7%, and earlier it used to be around 2 to 3%. So if you compare with the bond yield, still now dividend yields look attractive than the bond yield. So that way, and you have fairly predictable cash flow, and the business model is insulated from the demand shock, and they can maintain their core ROE at 18 to 19%. So that way, stocks are available at very attractive valuation.
I was just coming to that point, that how important is interest rates coming down in the system for some of these names? For somebody like a NTPC or a Power Grid that never make loss, always give dividend, it just comes into their favor?
See, interest rate scenario, this is a high regulated asset which are giving you a steady cash flows and steady ROE are always remain attractive because their discounting rate also comes down with respect to the declining interest rate. So that way, the investor prefer these stocks in the declining interest rate scenario. So that way, if you look at the cash flows, also even the interest cost saving they get from the lower interest rate, that way the valuation multiple go up because of in the falling interest rate scenario. So these companies get benefit in the falling interest rate.
Right. What will be your top picks in the sector?
See, we continue to remain positive on the regulated players. If you look at the last 3-4 years, the like NTPC, their regulated equity growth was hardly 6%. But we believe that they will continue to add close to 15 gigawatt of capacity and will drive close to 12% kind of regulated equity growth. Even they have a strong balance sheet, and they are their captive mining is on a track. So that way, the balance sheet is very strong, and they're getting entire their fixed cost returns based on their availability. So, and stock is trading at 0.8 times price to book value. This is a significant discount to the intrinsic value. So our top picks in the sector is the NTPC. We are also positive on the Tata Power. We believe that the key issues are already priced in, and we see some sort of resolution on the Mundra front that can be a trigger for the Tata Power. Also, the clarity on the Indonesian coal mining regulation is also sorted out, and all their 80% business are regulated, 80% portfolio are regulated. So, and they're now focused on the deleveraging their balance sheet, invade or strategic sale of their asset monetization. That can be a trigger for the stock. And stock is now available at just 0.6 times price to book value. So that Tata Power is our preferred bet in the power segment. Then we like the players like Power Grid from dividend yield perspective. Now the capex story for the power grid is already over, and we can expect a dividend payout ratio will go up significantly in the coming years. Now they are paying close to 8 rupees per dividend, and if you look at their cash flow analysis, they are generating close to 12,000 crore of profit, and if their capex in the next every year could be around 3,000 crore. So they are having a significant free cash flow for the investors, and they might increase their dividend payout ratio from the next year onwards. And even if you assume 12 rupees kind of dividend per share is available at dividend, and regularly their capex will be close to 10,000 crore versus 22,000 crore earlier. But that capex growth is also there, 5 to 6%. As well, you are getting the higher dividend, so that stocks also looks attractive from a dividend yield perspective. In the mid cap space, we also like CAC because their entire 80% they are operated under regulated regime, and they're assured. Only the few issues are there related to their Chandrapur plant where they have not signed PPA.
Right, Rupesh, really short on time. Rupesh, really short on time. Otherwise, we would have liked to take this discussion forward. Thanks so much. We got your top picks in the large cap and the mid cap space.